Well, hello everyone, and welcome to another episode of our Southern California housing market update. My name is Stephen Meade for Domicile Real Estate for people who love houses. We're located here in Southern California, so our stats are run based on Los Angeles and Orange counties. As always, if you are looking to buy or sell residential real estate in Southern California, we would love to help you out. Let's go ahead and get started. Kind of an ominous title here, and I don't mean to be doom and gloom, but if you watched us last week, I basically said, here's kind of my outline for the spring. And I said, there is one thing that could really upset that. And it looks like that one thing is now happening. So we're going to go through the stats, but I'm going to tell you, this is a situation where the skies are very sunny, but I'm looking over on the horizon there, and I see some kind of dark storm clouds. Now, who knows whether they'll make it here and how long they will stay? That remains to be seen, but just kind of what I am looking at. So let's go ahead, let's get started. Let's dive into the numbers. So here we are. So a couple things to note. We are continuing that downward trend that I had talked about previously on total active listings. This is not normal for the springtime. As you can see, where were we last year? We were at least flat and kind of growing in active listings through the spring. Right now, it's a very competitive market. Here, let's look at where we are. So in terms of total active listings under $1 million, last year, where were we at? Where prices were very similar to where they are today. We were at maybe 3,750 listings. Today, we are at just over 5,000 listings. That is not really that many more listings. If we look at our $1 to $2 million category, where were we before? Probably, low 2,000s. Where are we today? Right around 2,500. So, at the peak here, our number of active listings was way higher, right, last fall than it was versus the spring. And yet right now, that premium is maybe 20%, maybe more than we were at last year. Last year was an extreme low inventory environment. So we're not going to call this an extreme low inventory environment, but I would say we are firmly back into a low inventory environment. If we look at our new listings, this is kind of interesting too, right? If you look all of last year, let's start with that last year comparison. This is the number of new homes that have come onto the market in the last 14 days. So here we are, a little bit under 2,000. Where were we last year under $1 million? Gosh, almost 3,000 listings. So new listing volume is actually down by down by a third, right? In our under 1 million category, in our 1 to 2 million, we were maybe around 1,100 last year. Now we're at around 900. Not quite a 20% drop, but fairly close to that. If we look at our new escrows, right, those are down versus last year, but they're not down nearly as dramatically. And in fact, you see they kind of dove and then they rose back up. They're leveling off or even declining slightly. And I'm going to talk about that just a little bit because I think we're seeing the very beginning of something that kind of started about maybe a week ago. And I want to talk to you about that real quick. Our absorption rate is kind of interesting, right? This is kind of our down and dirty. How competitive is our market right now? And if you look here under $1 million, we are still at a rate where we are pulling homes off the market faster. They are going into escrow faster than new homes are coming up for sale. And we're still at a very healthy level here for 1 to 2 million. Still, in that mid 80s, that is a pretty strong, we'll call it a seller's market, maybe in that price range. Now, if we look at closed prices, now I want everyone to remember for a moment that this data is 4 to 6 weeks old. I know I say this every single time. And by the way, we're looking at ways to try to get data that's a little bit better because I'm going to go off share here just for a second because this is important. One of the issues that we have with our data is that we have basically this kind of 30-day sort of communication blackout on listings. So a home comes onto the market, people look at it, they write offers, boom, the status has changed. It is now under contract or in escrow. And there is a 30 to 40 day period on average where we know nothing about what is going on in that transaction. And that's really kind of a hole in data intelligence. So one of the things that the MLS is looking to do, and I fully support these efforts. Some of I sit on the board of directors of the nation's largest MLS, and one of the things that I think is important is have data about what happens once properties go into escrow. Now, for privacy reasons, we can't tell you what's happening to each individual house once it goes into escrow, but we can generate aggregate data. And we can generate data about things like how many offers were written this weekend. We can generate aggregate data like in a certain zip code, how many views did properties get online? And is that higher or lower than 2 weeks ago? This is important aggregate data that can really tell us a lot about market velocity and trajectory. So super excited to start getting that data. I think it's going to happen in the next 12 months. Obviously, as it does, we will start incorporating that data into these presentations because I think it is very important to tell us what's kind of going on in this sort of dark territory between when a home goes into escrow and when it actually closes. So if you look at this, you see something kind of interesting. Our upper end bumped upward, our low end bumped upward big time, and our middle or our median has kind of remained flat and is actually down a little bit. I think you're going to see that number pop back up, but again, it's delayed by 4 to 6 weeks. It is a look at the past, at where the market was. Okay, moving on to our still active after 14 days on market. I want to point out something really important here. Look at where this number and where this metric has gone for under $1 million. The last time it was at this level was back in May, between that May and June timeframe. So I do think that this is going to level out and maybe reverse based on some things I'm about to talk about. We've seen a little bit of a reversal here, but even for our 1 to 2 million, this is still at a level that it has not been at since June of last year. Make no mistake, this is not a fluke. This is real in the data. The markets have gotten more competitive. Many homes are seeing multiple bids, not necessarily like 10 to 20 bids, but maybe seeing things like 2 or 3 bids. If we look at our list to close ratio, this is another one, right? Like you gotta look at this data sort of both individually, but also together with some of these other measurements. We saw our list to close ratio go down, 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 not surprising. It bottomed, and look at the bounce that we took for our 1 to 2 million back to 100%. And then we've got maybe a little bit more tempered results here on our under 1 million, kind of going right back to that 99% level, which frankly is really kind of within that long-term normal that we see in the market, which is between 98 and 100%. If we look at our days on market for new contracts, again, under 1 million, look at how things peaked at the end of the year and then steadily began to drop. I think a big function of that was interest rates. A secondary function of that was, frankly, consumers just getting used to interest rates being where they are and being above 6%. And in our 1 to 2 million, we see that it's bounced a little bit, but we're still, lower off that peak number, right? I think we will tend to see this go down a little further just because we are in such a limited inventory environment. Now, the three-way. Let's talk about the three-way because I think this is probably one of the most important graphs that we do. It's one of my favorites. We have our January inflation data, and I've been really biting my tongue this whole video because I wanted to launch into this. We had a CPI number that really spiked in January versus what the expectation was. And there's a couple reasons for that. One is that housing actually is a component of the CPI. The other thing that's kind of interesting is that there was a recalculation and reweighting of some of the CPI terms that weighted some of the things that have gone up more heavily. So, how did the markets react to this? Well, there was a stock sell-off, with this. And also we saw a situation where the last week or so in the bond market, I think they saw this coming, has not been great. And the bond market is important because the bond market really is the overall sort of look at confidence about inflation in the future, and that is what drives mortgage rates. It's the feeling not about inflation necessarily now, but about inflation 6 months from now, a year from now, 5 years from now, 10 years from now. So, okay, that's inflation. We saw that creep up. Rents are pretty much holding steady, but because that median price showed a downward trend, and because this does not reflect some of the most recent days of mortgage rate increases, um, look at how close this line has become. And we've always talked about this really being a measurement of health in our market, right? Is that disparity between renting and buying, right? And when you find that the buying gets way out of whack versus the renting, that's really when you're setting yourself up for a market crash, because that means there's a normal equalizing function that's not happening. And as those more diverge, kind of the harder things are going to fall. But as we see, these have come back together quite a bit. I think this is going to bounce back because of those interest rates. And we might even see these rents bump up a little bit more. But this is in a zone that's pretty healthy in terms of market health. So if you're expecting some sort of a large scale market crash, I don't really think it's going to happen. We might see market adjustments if rates continue towards 7% and stay up there for a while. We might see some, what I think are kind of like tweaking adjustments to price. But I'm going to stand by, a statement that I've been making for a while now. And that statement is, my expectation for 2023 is that we're going to be within the range of plus or minus 5% of prices. Meaning, I think all things being equal, they're going to tend to be pretty flat. Obviously, if rates bump down again, we might see more towards that 5% jump. If they stay towards 7%, we might see more towards a 5% decline. But I'm really not seeing big moves happening in this market. So if you're taking a look at this, what does this mean if you're a seller, right? Well, if you're a seller, I think it means what we've been talking about the last few months. Make sure you have a house that's a great product. Nobody complains that their house was too competitive in the marketplace when they went to sell it. Nobody really complains that they got too much activity. So err on the side of making an attractive house to sell. I think, you really want to watch where that interest rate market is if you're a seller, because that really is kind of what sort of the pendulum, that's really what's operating the pendulum at the fulcrum. A little change in those rates seems to change the demand in a pretty big way. If you are a buyer, I'm going to go off screen share for a buyer. If you're a buyer, you're kind of frankly in a little bit of a tough spot, right? Because I think you might see these rate increases. You might watch this video and think, oh my gosh, I'm afraid of everything that's happening. I don't want to do anything. And the problem with that mentality is I don't foresee the relationship of things getting better for you. And the reason why I don't see that happening is because we simply do not have enough inventory. And inventory is really what's required to see your situation improve, because you don't just need prices to move a little bit. You need prices to move a lot, or you need interest rates to move a lot to make things better for you. And I don't see interest rates, at least in the next 6 months, having huge drops. I could be wrong about this. And I really don't see that inventory situation changing very much. In fact, I think it might get a little bit worse before it gets any better. But I think this is kind of the range we're going to be playing in, right? A little bit higher inventory or a little bit less inventory. But I don't think you're going to see suddenly there be tons of inventory. And, if you're a buyer, this is something that I try to remember, right? Is that if you talk to anyone who bought a home 10 or more years ago, pretty universally, most of them will tell you they wish they had bought sooner. And I think you really want to be thinking in that long-term time horizon. We do these videos because I want you to understand what the marketplace is like when you're out there in it and what's going on right now. But the reality is you really want to look towards a broader horizon. You want to look deeper onto that horizon when you're making these kinds of choices. And I think as human beings, we suffer this kind of sort of built-in bias to sort of stare at our feet and look at what's right on the ground and become almost obsessed with it, instead of really tilting our heads upward and looking farther down into that horizon. So we've got one more slide left. We're going to talk about interest rates. This chart does not show Freddie's latest survey. It's going to be up. We're going to see it more towards that mid 6% mark. That's just sort of the reality. I'm sorry. I wish I could change that if you're a buyer, but I can't. I wish I could change that if you're a seller, but I can't. It's just the way that it is. We're really going to have to watch sort of, where the Fed is and where things move. And I think part of the problem is that we have this kind of like balance scale of things. And what I mean by that is, believe it or not, thinking there's going to be a recession generally produces lower interest rates or the expectation of lower interest rates, which is good. And that also tends to spur housing prices. So when people think recession, they think houses are going to be cheaper. Not usually the case. But you intuitively think that now there's less talk about the certainty of a recession. And that has actually produced, that kind of the opposite effect, right? It's made interest rates a little bit more robust. People are now worried again that the Fed is going to maybe go back to 0.5% increases. The last one was only 0.25%. They're going to do that to really rein this economy in. And I think that the Fed has made the statement several times now that they want to make sure inflation is slayed before they let up. And the results that we got this January say that we still have a little bit more, or maybe more than we thought, to go on that front. That's all I've got for you. Again, if you are looking to buy or sell residential real estate in Southern California, investments for your own personal residence, we would love to talk to you. Definitely reach out. Don't forget to like, subscribe, and hit that notification bell. Questions and comments, as always, we love them. And we will see you again real soon.